Right, let's get right into it. We are witnessing one of the biggest shifts in finance ever. We're going from cash to code. Think about it. You use money every single day. Cash, cards, a quick tap on your phone. It all feels so simple, so solid. Like it's something you control. But what if money isn't really what you think it is anymore? Because what's happening right now is that money isn't just moving, it's being programmed. And that brings up the real question, the one that matters most. When cash becomes code, who's writing the rules? Okay, before we dive any deeper, just a quick heads up. This explainer on the channel Blocks Bonds Funds is purely for educational and informational purposes. It is not and should not be taken as financial or investment advice. All right. So to really get a handle on where we're headed, we've got to first understand what money is right here, right now. So at its absolute core, money really only does three things. It's a medium of exchange, for buying stuff. It's a store of value, so you can save for later. And it's a unit of account, which just means it's how we price everything. Sounds simple, right? Well, this is where things start to get a little more interesting. You see, the system we have right now is kind of split into two layers. You've got the central bank at the top, creating what's called public money. That's the physical cash in our pockets and the digital reserves that commercial banks hold. But here's the kicker. Most of the money we actually use, the numbers you see in your bank account, that's actually private money. It's created by commercial banks whenever they give out a loan. They are the gatekeepers. But as we use less and less physical cash, our direct connection to that public money is starting to fade away. And that gap? Well, that gap is setting the stage for a totally new kind of money. So what on earth is a CBDC? A central bank digital currency, or CBDC, is pretty much what it sounds like, a digital version of a country's official currency. But here's the critical difference. It's a direct claim on the central bank itself. It's just like the cash in your wallet, but it exists purely as code. No middleman. Now, not all CBDCs are built the same. They basically come in two main flavors. You've got retail CBDCs, which are for everyday people like you and me. Think of it as a digital replacement for cash. Then there's wholesale, which is for the big financial players, the banks, for settling massive transactions. For this conversation, we're really going to focus on that retail version. Okay, so how would you even use it? Well, there are two main models being kicked around. An account-based system would tie ownership directly to your verified identity, exactly like your bank account does now. But a token-based system, now that's more like physical cash. Your ownership is proven simply by possessing the token. The system doesn't need to know who you are, just that your token is legit. So we get what it is, but how does this thing actually work? Let's pop the hood and take a look at the architecture behind this new system. Now, this is where it gets really interesting. Even though a CBDC is a direct liability of the central bank, most of the designs being proposed are still two-tier. It means the central bank issues the currency, but our familiar commercial banks would handle the day-to-day stuff, the wallets, the customer service. It's a kind of hybrid approach, trying to get the security of the central bank with the innovation of the private sector. The tech itself is built in a few key layers. At the very bottom, you have the core ledger. That's the central bank's absolute source of truth. Then there's the processing layer, where all the intermediaries handle the transactions. And finally, you have the part you see, the digital wallets and the whole process for getting you verified and on board. And this right here, this is the real game changer. Programmability. We're not just talking about digital money. We're talking about smart money. Money that can be programmed with rules. Just imagine payments that only go through when a package gets delivered, or a salary that streams into your account every single second. This unlocks the ability to automate financial agreements in a way that's never been possible before. This new power is, well, it's incredible, but like any revolutionary technology, it forces us to make a choice. There are trade-offs, so let's really dig into this landscape of both promise and peril. The promise, the upside, is huge, and it's really all about efficiency. Proponents argue that CBDCs could lead to way faster, cheaper payments. They could bring millions of people who don't have bank accounts into the financial system. Plus, they could create a whole new platform for innovation and make our entire payment network more robust. But, and this is a big but, that pursuit of efficiency creates a huge tension with two other really important things: financial stability and our personal privacy. A CBDC could destabilize the banking system, create a tool for financial surveillance on a scale we've never seen, centralize an incredible amount of power, and open up brand new vulnerabilities for cyber attacks. The biggest risk to stability is something called disintermediation, a fancy way of saying cutting the banks out of the picture. In normal times, this might be a slow drain, where people gradually move their savings to a central bank CBDC. But during a crisis, well, then you could see fast disintermediation, a digital bank run where billions could flee the banking system in a matter of minutes. That could break the system as we know it. And all of this brings us to the ultimate question that this technology forces us to confront. It's not just about efficiency or risk, it's about a fundamental tectonic shift in control. With a currency that's fully digital and programmable, central banks get some incredibly powerful new tools to steer the economy. For instance, they could directly apply negative interest rates to the money in your digital wallet. What does that mean? It means they could try to force you to spend during a recession. In a world like that, your money would literally lose value just by sitting there. And that leads us to the fundamental trade-off with privacy. In a system where every single transaction can be recorded on a central ledger, what happens to financial privacy? How much is left? The choices made here will have huge, profound implications for personal freedom. And just to be crystal clear, this isn't some science fiction idea for the distant future. This is happening right now. The Bahamas already has its sand dollar. China is running massive pilot programs for its digital yuan. Over 80% of the world's central banks are actively exploring CBDCs. The global race is on. So, the most crucial takeaway is this. We're living through one of the biggest transformations in the history of money. It isn't just changing its form, from a physical thing to lines of code. Its very structure of control is changing. This shift from cash to code is about so much more than just technology. It's about redefining our entire relationship with money, with efficiency, and with power. So the real question for all of us is, what kind of system do we actually want to build?